What's going on, everybody, and welcome to another edition of the Prosperity Through Multifamily Real Estate Investing podcast. I'm your host, Cody Laughlin, and joining me, as always, Mr. John Batey. How you doing today?
Fantastic. Glad to be here.
Awesome, man. Awesome. Well, I'm glad you're here as well, and looking forward to getting into the interview today with our very special guest, Mr. Hadar Orkibi. Hadar, how you doing?
I'm very good. Thank you. Thank you for having me, Cody and John. Glad to be here.
Absolutely,
Honored.
man. Absolutely. Well, listen, before we get started, here's a little bit about Hadar. He started his real estate careers as an agent in Israel before immigrating to New Zealand in 2003, spending the first 3 years educating himself and trading real estate while working at the vineyards and orchards of Central Otago in New Zealand. With nearly 2 decades of full real estate experience, Hadar specializes in long distance, out of area and out of the country investing, and is an asset manager with mfiholding.com. Hadar's portfolio includes multifamily apartments and commercial real estate in New Zealand and the United States that allows him to exit the rat race and with passive income and live lifestyle by design with his family. Over the years, Hadar implemented different strategies, which includes wholesaling, house flipping, subdivision, new construction, commercial real estate, joint ventures, and multifamily investing. Hadar enjoys helping both seasoned and beginner real estate investors reach their wealth, income, and portfolio goals through multifamily real estate. Hadar is a coach with Jake and Gino and MIHmastermind.com. So man, Hadar, great story, great bio, man. Looking forward to learning more about you. So dive into that a little bit, man. Tell us a little bit more about yourself.
Yes, so the bio really covered a lot about that. On a nutshell, I can say that I've been doing it for close to 20 years now. Started in Israel and then slowly rolled into growing my portfolio. I started as a wholesaler, gradually signing contracts for fees, anything between $5,000 to $20,000, and then started doing more at larger margins transactions, contemporaneous settlements. So basically double closing, which typically allowed to have a larger margin in between. These were mainly houses in New Zealand. And gradually I built up enough cash to start buying a buy and hold portfolio, which consists of small multi-families. In the beginning, I bought a couple of houses, but then I quickly realized that I want to be in the multiple income stream assets, which they have a lot of advantages to them, which we're going to cover about why multifamily as a whole. So I built a portfolio of those smaller multifamily because in New Zealand, you're unable to buy large multifamily like 20, 30, 50, 100 units. There's no purpose-built apartment communities for kind of built to rent. So most of the multifamily are duplex, triplex, quads, maybe a 10plex, and that's pretty much it under one ownership of an investor. With that, I gradually also build a portfolio of some commercial real estate, mainly retail. And at some point, within the last, if you like, 6 to 7 years, my portfolio appreciates significantly in New Zealand. I invest in markets which they are similar to, if you like, Boston, New York, Los Angeles, San Francisco, markets that if you got into them 15 years ago, and now you own an asset, it will cash flow because the rent have increased. But at the same time, the asset value increased so much and the cap rate compressed so much. So at the moment, if I want, from about 5 or 6 or 7 years ago, if I want to keep growing my portfolio, I'm not unable to do that in terms of cash flow by keep investing in Auckland, in New Zealand. So about 4 years ago, I started looking into investing in the US for markets that has a better price to rent ratio, if you like. So that was one of the reasons that I looked into investing in America, because I wanted to keep growing my portfolio with assets that generate significant cash flow. And as an American citizen, which I am, I was able to get into the US market, establish relationship with local community banks, and start buying assets.
Wow, man, that's impressive. So I want to go back and kind of talk about that. And you're currently still living in New Zealand, and you're operating your portfolio from there. And like you said, you had both assets there and New Zealand. In establishing your portfolio in the United States from afar, how did you manage that?
This is actually a question which everybody asks me, and I will give you some tips about that. But if somebody really wants to dive in, if any of the listeners really wants to dive into that particular subject, I actually put together a video course and an ebook which they can find on my mfiholding.com website. So if you want to put a link to it in the show notes, people can download that and get the whole 1 hour presentation and the ebook to learn specifically. But the first thing that comes to mind when you want to invest from out of area, if you like, whether if you're on the East Coast wants to invest in Texas or in Oklahoma or Alabama or anywhere really, if you want to invest in out of areas location, the first thing to do is to get your mindset set up and really realize that you can make it happen if you build the right team on the ground and if you get to know the market properly. So if I can fly 14 hours from New Zealand to the States and make it happen, you can do it too if you're in the US and you need to fly 2 hours for 3 hours or even drive 6 or 7 hours or whatever. It's totally doable. It's just a matter of being focused on the goal, realizing when you want to do it and execute. So the first thing we teach and the first thing that any investor wants to do if they're looking in a different market is choosing the right market. You really want to be in a position that you research the market. And once you decided that you find a market that has good fundamentals of job growth, population growth, and various other important factors, you want to focus on one market. You really don't want to focus on multiple markets in one time. And one of the main reasons for that is because when you focus on one market, not only you get to know the market really good and really intimately, you get to establish those relationships that in the end of the day will make or break your business. You want to have solid relationships with a good property managed company. You want to have a good solid relationship with lenders in that market, and you want to have a good solid relationship with brokers in that market. Yep. And it's really hard to be focused on multiple markets at the same time, because you also need to be willing to invest your time to visit the market. So you really want to, if you're in the US, there's no reason that you're not going to visit your market at least once a month. And if it's somewhere which is like, let's say 5 hour drives, up to 5 or 6 hour drive from where you live, you can visit it even twice a month. There's no reason why you shouldn't do that, because this is your business. You want to take it to the next level. You really need to dedicate some time and be prepared to do it. You need to be present in that market. If you want to gain traction and get to know the market, you need to be present. You need to really get to know the areas, get to know the streets, get to know the location, drive for dollar, create those relationships with other fellow investors and attend some local meetups. Very, very important, because you want to be immersing yourself in the market, that not only you get to know the market, people get to know you.
Yeah, that's a great point, and I'm glad you brought that up, because a lot of people just getting into the space have that tendency to kind of overextend themselves and target a bunch of different markets. And I know I was a victim or guilty of that myself, and I was looking at several different markets and not really being able to establish that team. So we had to scale that back. And you're right. Once you are able to focus on that one market, that's really where you have that advantage. But talk to us a little bit about what are some key things that we need to look at in identifying a market. What's a good market for us to focus on?
So you really want to focus on a market. First of all, you need to decide on your strategy. So what is your real estate investing strategy? I mean, there are people who invest in market that the price to rent ratio perhaps is not as attractive to me as I would like it to be. So it really depends on your strategy, whether you are a cash flow strategy, or whether you are more like of a buy an asset, syndicate it, stabilize it, and then sell it for a profit, which is pretty much trading assets. It's flipping apartment communities. A lot of people did that from about 2014 until 2018, and even some today. But with the current economic situation and the coronavirus, this is a strategy which I would not suggest to anybody to do right now, because they are doing, it's kind of a risk of assuming that you can take the rent, especially if you like, in a softening market or even a falling market. Again, this is maybe specific in certain locations. There is more demand than others, but again, you really need to decide what strategy you want to apply before you choose the market. Please, John.
Were you switching your strategies, or are you sticking with one strategy throughout the entire time in your career, at least in multifamily?
Good question. When I started, I tried a lot of strategies. I tried anything from wholesaling, which helped me to pick up momentum with accumulate some cash and down payments. And then I tried some lease options and stuff like that, which I decided that it's not for me. I tried some, I've done some developments like the bio said. I've done small development, subdivisions. Each strategy we can apply to a different location, different assets, and of course, different strategies with different phases of the real estate cycle, which is another subject which I'm very passionate about, because the cycle changes a lot. And in each part of the cycle, you can apply different strategies. But when we just touch on multifamily, no, I'm not changing my strategy. I'm laser focused on one strategy, and I find it to be very, very important for me, because I have a clear idea of what I'm looking for and where I'm going. So in a nutshell, my strategy is to buy underperforming asset / businesses. I see it as a business. When you buy 20 unit, 30 unit commercial property, which let's talk about multifamily, it is a commercial transaction. You're buying a business, if you like, that is not functioning well. Maybe they are poor management. Maybe there are some problems that you can fix in the building structurally. And when you fix those ones, you increase the income, which effectively will add value to the property and will generate significant cash flow. So those two elements that I'm looking for is the ability to push the equity up and also push the income up and basically generate enough equity so I can refi and roll the money from this deal to the next one, but also then have, if you like, close to no money down in the deal, which will still generate significant income and will create close to an infinite return on the money. And it's doable. My latest deal is like that. I mean, I haven't refined it yet, but the numbers are there to support my strategy.
Yep. And your whole team is aligned with this strategy, obviously. I mean, you've got to have your lenders on board, your brokers know what you want to look for. And so they know when you come to them, they know what the strategy is and what you're going for. So they know what to bring you.
Yes. In today's market, I need to remind them as well that we're not buying anything which is fully stabilized, because there's just not enough meat on the bone.
Right.
And we also like to see minimum of 15% loss to lease. Loss to lease is basically, for example, if your rents are $100,000 a year, just to keep the number clear, but if you can take them to $150,000, which is the market rent, that has a $50,000 margin, but that means that your loss to lease is $50,000. Or in percentage-wise, we like to see minimum 15% loss to lease, because if you have that, this is the easiest way to create value and add value in commercial real estate, is to increase the rent to market. If you have a property that has enough meat on the bone, meaning a lot of under-rented apartments or even commercial real estate, that's the easiest way to add value. But I do want to go back to your question about what to look for in the market, and I'll just touch on that briefly, because this is a long subject that we could look on various things. Basically, we are talking about job growth, unemployment. You want to look for how landlord friendly is the state. Nowadays, there is a lot of changes with the Tenancy Act, Residential Tenancy Act, and restrictions of evictions and how you be able to manage your properties, like the new bills that passed in Oregon and the stricter criteria in terms of landlords, how they can deal with tenant in New York. And it's very, very important to be in a landlord-friendly state when you could have enough control on your investment. And another point to mention is not just job growth and population growth, is to check how friendly is the actual state, if you like, towards business. If they're encouraging new business to move into town, if they encourage, if there are any tax credits and incentives for businesses to move into town or into the states, all of these are very important, because in the end of the day, what creates demand is having more people. So you want to have significant enough growth. Even for me in my market in Arkansas, there is enough growth to keep it flat, steady as she goes market, but nothing is declining like Detroit had, you know, in the last 10 years or so. So you want to make sure that you're in a steady, and you want to make sure that you know what you're investing in.
So let's break that down a little bit on job growth and population growth. You mentioned you're looking for something stable, but are you looking for kind of, you know, we hear things all the time. Oh, we need 2% growth in both, you know, job and population growth. You know, that's what some people put out there. But you're saying at least flat.
Well,
or what?
I mean flat in terms of not losing people and staying above the line. But ideally, I want to see a minimum 2% of you know, job growth year on year, consecutive year. That's
right.
The kind of what we see.
Okay.
And another thing we want to see in the market, in the sub market, which means I might invest in the metro, but within the metro there is 1.5 million people. I mean, I want to see a metro that has at least 1 million people, and the metro could include other small cities which are adjoining to the main city. And I like to see a minimum median income of $50,000.
Yeah.
And so that means that the household income will be minimum of $50,000. And I want to see that houses there worth averaging about $150,000. So that's kind of create an equilibrium that you got enough people who actually want to rent or need to rent because they can't buy a house.
Yeah. So you're looking at the affordability, you know, kind of buy versus rent type.
Yes.
That's what you're describing, right?
Yes.
Yeah.
Yes. Yes. And there is another point that we're looking, guys. I wasn't prepared for it to answer, but you just opened the floodgates, if you like. Is that another one thing you want to look at? Very, very important is the supply versus absorption. So you want to look on what's going on in the market in terms of new builds. If there is a lot of construction going on, it is a great sign, and it's a good sign that there is a lot of trust in the market, and maybe the market has some momentum and people are investing in the market. But if there is oversupply of apartments coming up in A-type class apartments, but there isn't enough population growth or job growth, or maybe there is a totally black swan event like we're having now, something that nobody predicted, and suddenly you have a situation when there is a lot of layoffs and unemployment could grow. It's another point we want to look at unemployment. Unemployment is very important. We can touch on that in a second. You want to be clear that whatever is being built can be absorbed, because if it's not, then that will create a ripple effect of reduction in rents, because those one will have to drop the rents down, which will create a ripple effect, which will potentially decrease the rent that you can achieve, which could affect your market.
Yeah, it's a great point. Supply and demand, like any market, extremely important. But practically, how do people find that out? Are they usually going to their brokers and kind of pulling CoStar reports for that submarket or MSA? Or what are your techniques?
Few tips on that. First of all, a lot of the large brokerage, they have a lot of information, so they release datas quarterly, typically. I know Colors International, CBRE, they have some reports. Whoever is dominant in the market, they release some data. That's number one. Very, very important to ask about absorption-based supply construction. Another great way to know is to go to the city and ask them to see how many permits have been issued this year, the first quarter, just even quarter by quarter. So you can keep a gauge on that. Another great way to keep an eye on the market, two great ways I'll touch on, is one is to talk to your Chamber of Commerce. Chamber of Commerce are very, very, if you like, involved in the business community in any specific market, and they would know if there is any new business moving to town. And that's another thing we look for. We always look for which businesses are moving to town, which business are expanding, which businesses like Amazon or Walmart or whatever. Even we have in the port of Little Rock, we have a few other businesses that are moving into town to open assembly plants and various things, which will attract, for example, 600 jobs. So the Chamber of Commerce knows all of that. So Chamber of Commerce is very good. They're very friendly. You don't have to be a member to ring them and talk to the head guy and just tell them, I'm investing locally in the market. We're looking to deploy a few $1 million here on apartments. And we want to, I was calling to hear some feedbacks. Where is the path of progress? Do you know of any new businesses that are coming into town to maybe expand? Or maybe he knows other news that some businesses are closing down and moving out of town.
Perfect.
Yeah, that's great. And then I'm so glad you pointed that out. I want to go back, Hadar, to the correlation of supply versus absorption and how that relates to market cycles, because I know you mentioned that's something that you're very passionate about. Talk to us about market cycles and how that relates to one another.
Okay, this is another subject. It's a deep subject. There's a lot of moving parts. So it could be a show on their own. I actually done a show in New Zealand on their own about this. But basically, the cycle has 4 stages. It's got 3 main stages, but it's got 4 stages in terms of the boom, the slump, the recession, and the recovery. So each section, each phase or inning, some people call it, has different things that happen within that and different, if you like, indicators and drivers that drive the section, and indicators which are there to actually allows you to see it as an indicator and figure out where you're at in the real estate cycle. So, of course, we have now, and if you look at it, you can look at it like a property clock. So you got the real estate clock, and you got 12 o'clock is the boom, but that's the top of the boom. But the boom is actually starts from example, if you like, starts at around 9 p.m. or 9 a.m. Doesn't matter. It doesn't have an a.m. p.m. 9 until about, let's say, 1 to 2. That's kind of the high part. And when it passes 2, it's where we are now. We are really going, and then we're going to pass 3, and then we're going to go to 6, which is, for example, a recession or past the slump down at the bottom. The optimum time to buy is at the bottom, but a lot of people will not, if they're not involved and active in the market, they will not identify the bottom. But if you are active in the market all the time, still looking at reading data and trying to buy things and being active, talking to brokers, which is an important point I'm going to touch in a second, why, you'll be able to just feel when is it reaching the bottom. Because once you figure out that properties are taking longer to sell, you will realize that the market is really slowed down. So less people jumping in to buy. And that's the time to actually be more active. As Warren Buffett says, be fearful when people are greedy and greedy when people are fearful. So this is the time to buy. But the optimum time to buy is just past 6 o'clock, which is basically the little green shoots of the recovery, if you like, when they're starting to come up. And you can see that because property are taking a little bit longer to sell. There's more people in the open homes. There is more momentum. You can feel that if you're in the market. And that is the time that a lot of developers buy land or get their plans ready so they can start developing and building later on in the cycle when the market is going up and absorption grows towards the peak. To answer your question, John.
That's perfect. Can you see that? So say you're talking to a city or chamber of commerce, you can probably see that in the permitting then. Even other developments that are going on, single family housing, not multifamily necessarily.
Yeah. You can see that with the permits. You can monitor the permits, and you can monitor a lot of other things which I cover in my book, real estate cycle, the different phases and the strategies of each phase. And if anybody wants to get this book, you can jump on the MIH Mastermind website, and there is a link there to this book which you can get for free. So again, it's a topic that I researched, and it's a topic that you can read on and learn if you get that ebook.
Yep.
What I do suggest, John, to every investor that wants to invest in a market, which is whether he lives in that market or whether it's out of area market, is to subscribe to a newspaper. I subscribe to an online publication which has a newspaper as well, of a business community. So if you signed up for that, and they have a lot of the updates about what's being built, what's being sold, which businesses are moving to town, which businesses are merging, which banks are doing loans, which banks are merging, and just a lot of information about the business. This is a great way to stay in tune, and you have to do it if you have real estate and you want to be good and you want to be professional and you want to be ahead of your competitive. You have to stay present. You have to know what you're talking about.
That's great. Yeah, I like the local newspaper idea. We have one in North Houston where I'm at, and it's very specific. I mean, this CBD oil shop is opening up, and this medical center is being built, and it's very specific to this 9 by 10 block size area, and so it's important. From a broker perspective, what when you're going through this trough and you've got the pulse on the market, what kind of things are you asking to your broker that you would not necessarily otherwise ask to try to feel the bottom out?
Yeah, so hopefully by the time you kind of people starting at any stage of the cycle, but hopefully by the time you kind of in a position that you pass the peak, you have a stabilized relationship with brokers that will give you the heads up if there is an opportunity to buy a deal, which will be at a discount or from somebody who is distressed, who doesn't want to go to market, and they just want to offload these properties. So the main thing to ask again is if you want to have a gauge for where the market is how long things are taking to sell. How many offers did they have? Was any properties had recently some price reduction or adjustment if they get the feedback from buyers that the price needs to be lowered? Where do they feel that people sitting on the fence more, or are they still in a hurry paying high prices? And you can see that if you monitor deals, then you can see what they're selling for. So if I see a deal in my market which I decided not to pull the trigger on or not even put an offer on because the price expectations were too high, I always follow up with the broker, and I want to know what it's sold for. And I want to know exactly because I want to make sure that I know where the market is and what people are willing to pay. We often see people coming from California or the East Coast and paying prices for properties which we wouldn't pay. Okay, that might be maybe two reasons for it. First reason would be that they think it's a good cap rate because they only get 3 or 4 cap, and they think that 6 cap is good, or even 7 cap in some locations, which I wouldn't pay. Or maybe it's indicator who has money to deploy, and they just have to deploy that money so they can use the money and keep their investors happy and give them even 4%. So they just satisfy the needs, and they can clip their acquisition fee and asset management fees and all those things. So this is why people are paying too much. The other thing is some people do 1031s and they just want to shoot the money into a deal. So that's another thing that we see a lot. Another question to ask about the market with one of your professionals is for example, a loan officer. You can ask them if they're seeing any delinquencies in the loan, any people having difficulties to pay the loan, and just find out a bit more about that. I know that in the last global financial crisis in 2008 to 2010, there was actually a lot of opportunities to buy underperforming notes. So you're basically buying the note for the property at sometime 50% of the value or even less, and because the people just wanted to get out, so they basically handed the key, and you could basically just buy the property from the lender by taking over the note. So I don't know if it's going to be available right now, but I know that my lender rang me the other day to ask me how we're going now with all this coronavirus and everything, because he had some investors that reached out to him and told him that they had some tenants ringing that they can't pay, and he was worried, and he just wanted to talk to the bank in advance, which is another another point.
Yeah, no, that's a great point. Cody and I were talking about the other day. We're monitoring credit spreads pretty tight right now, day by day. Because they've significantly escalated with this coronavirus, and they actually haven't come off that much. The option adjusted spreads. So it's definitely something to watch, folks, especially in the CMBS market. It's still in distress as far as I can tell. Because all these hotel and leisure folks have 0% occupancy, and if you're a hotel and you have 0% occupancy, you have zero revenue.
I'm actually doing a presentation with Marco on next week, which is probably not going to be in time for the listeners of this podcast to take place. But you guys are invited. I'll send you the link, and everybody, if they listen to that and they want to touch base, it's courtesy of the MIH Mastermind. We're doing free education sessions, perhaps once a month or something like that, about different topics. So we're going to talk about how to survive in a falling market, really what strategy you should do. And we're going to cover a lot of those strategies that we implemented through the last 2 cycles to really mitigate the risk and also position yourself to take advantage of the market and prosper in a falling market.
Yeah. Well, we appreciate that. We'll definitely make sure that's in the show notes for sure. And people can go back and reference by the time this recording's out, but we're looking forward to being a part of that next week as well, for sure. But I want to kind of go back and kind of connect the dots here, especially as we were talking through understanding, the cycles and real estate, and the first points that we were talking to earlier about sticking to one market. I think it's important for people to understand that every market could be different. What we're facing now with the coronavirus and the global economic downturn that we're seeing, it's impacting us all. But in general, would you agree that one market may be in a different part of the cycle versus another market? So you definitely want to make sure that you understand that. And that could be another reason why you want to be focused in one market. Do you want to really be in a market that's at the top of an expansion versus, like you said, coming out of a recession?
Yeah, totally agree. I mean, there are micro markets within a market. So even in a city, there will be some neighborhoods that affluent neighborhoods that will not suffer as much as the neighborhoods around it. Mm-hmm. And you have that in the US. We had it in the global financial crisis. And also every cycle is different. Some cycles are a bit longer, like the one we had now. We had an expansion for over 10 years. And other cycles are a bit shorter. There is theories that there is actually a larger cycle, which is every 75 years, that leads to a depression. So there's many, many, many different cycles and many different theories. The main thing is to keep your ears to the ground, keep active, and really monitor those indicators that will indicate to you if we're going towards a slowdown. I think that it's very important to do that.
Let's go back to unemployment real quick, just so we don't skip that one out. When we were talking job growth, we talked population growth. Let's touch back on unemployment.
Yes. So in 2010, I believe, 2010, 2009, the unemployment rate in the US were about 9%, 9.5%. That's around back then, just in the middle of the global financial crisis. Now the unemployment in the US as a whole is about 3% from memory. So, that's up to the coronavirus. Now we want to see really markets that have an unemployment rate of under 5%. We don't want to see markets that have an unemployment rate of 5%. Anything below that fluctuation, let's say 3 to 4, we could work with. But again, if you know your sub-market and you know that you're in a sub-market, a neighborhood that has good demand, you mitigate the risk. So you really need to know the pockets within your market. But as a market as a whole, you want to avoid towns and areas that has one large employers. You don't want to invest in a town that has only one timber mill, or only one employer, or only one army base, or something that is really based on one outfit, one operation, one big employer, large employer. You want to avoid those towns. That's one of my criteria. I don't do that. I don't do flat plains, and then I don't do into small economics points that we discussed. They have to fit in. Now with the coronavirus, there are various talk, and I'm going to expand on it in the session on about surviving in a falling market. It's really, there are talks about potentially 20% unemployment, even 30, some people says. Now, we don't want to scaremonger, but we have to be prepared. And for us as multifamily investors, it all comes down at the end to economic occupancy, because people are not going to be necessarily shifting a house or changing or leaving. When you do the tenant selection, you really want to be trying hard to stick to people who's got a good credit record with high credit score of 600 or more, so you can they're credit worthy in terms of not just the score as a score, but just maybe the mentality. Because people who try to keep the credit right and everything, they got the right mentality not to default. So this is something that's really important, because they might not be able to really pay the rent because they got laid off, but if they got the right mentality, you'll work with them long term to retain them, because you really want to focus now on tenant retention in opposed to just evicting. You can't even evict. And if you got an agency debt loan and you get a concession from them that they give you a break to not pay the loan for maybe 90 days or 12 months, the agency did not allow you to evict within that time frame. For Bowdens, for when they really not letting you to do that. So you can't really able to evict anyway, and the courts are closed. So people really need to be smart about how they manage their assets right now in the crisis that we are in.
Yeah, no, that's a great point. Go back and define economic vacancy for maybe some of the listeners who may have struggled with understanding the difference between that and physical occupancy. Talk about that a little bit more.
Okay, so when you look on when you talk with the with a broker or whether you're working directly with the seller, if it's an off-market opportunity, which is a lot of the deals that I do, basically you're receiving the rent roll, and then you're looking at the rent roll and you're looking what kind of rents each apartment is getting, and then you work out what's the occupancy rate, because you see how many rent units there are and how many what they pay and how many units paying rent. So what you want to make sure is that there is physical occupancy, means that there are people living in those apartments. So he can tell you, we are 90% occupied. So they have 90% people filling those apartments up to 90%. But the economic occupancy is maybe 80%, because within the 90%, you might have 10% of people who are there, but they're not actually paying the rent. So the difference between physical occupancy is having just people living in those apartments, but some of them might not be paying rent. Maybe they're delinquent, they're not paying. It happened to us with the latest deal. We were 20%, 25% vacancy physically, but we also had at least another 5% of economic vacancy, which means another 5% within weren't actually paying. So that's the difference. And you need to find out when you buy. And the way to do that is to first you do a lease audit when you buy a property. So you get copies of all the leases, which again indicate physical occupancy, but you really then need to ask for a delinquency report and even bank statements to see, the management statement to see that those people actually pay their rent.
No, that's great.
Trust but verify.
Yeah, that's a great point, and I appreciate you elaborating on that. Some people can sometimes, as you mentioned, especially if you're just getting into the space or just starting to see financials, some people may miss the importance of understanding that difference between those. So, good point. Especially as you mentioned, now if we're going to see unemployment rates just really skyrocket here for the next couple of months, you're going to see high economic vacancies, and that's really what's going to impact.
We had 3.3 million unemployment claims on Friday.
Yeah. Wow. So,
guys, I'd like to mention, just to touch on that, Cody, is that now things have changed. The way you underwrite deals, the way you will be underwriting deals moving forward, you cannot underwrite deals on actuals of today, and you cannot underwrite deals of trailing 12 or anything like that was in the past. Because from about May to 2020, we are now in the end of March 2020, from about April, May, I say May 2020, you will really see who cannot pay and how is it performing. May, June, you'll start seeing a lot of delinquencies, and economic occupancy will be tough. So you have to have your assumptions and your underwriting very, very conservatively. And that's the time to be very, very strict with your criteria, and they have different strategy to walk through to actually put a deal together in a market like that. But that's a different subject. But what I'm saying, be careful how you trade. It's still going to be opportunities. Just be more conservative and allow for those unknowns. Mm-hmm. For the next 18 months to 2 years, we might have a bumpy road. This thing is not going to go overnight unless there is a vaccine, and that's at least a year away.
And talk to us a little bit about what has been your experience so far since the onset of this crisis. What are some of the lenders saying as far as their underwriting and some of the practice changes that they've already implemented already?
So really, I would like to say, let me just, if you don't mind, give me a sec here. I'll want to just open here something. I wrote some notes about that when I talked to my lender just the other day. Yes, so first of all, I talked to a few owners that I know in my market, and I became actually friends with them, and I got to know them. A bit of a background. Few owners own a few hundred communities and apartments within my market. And I got to know them through doing direct mail marketing and then cold calling. And I built a rapport with them. And this is another important point to do when you're targeting a market, is to really get to know who are the biggest players in the market, who owns what. And you want to make relationship with those people. You want to build a relationship with them. I actually created a catalog of all the properties that they own. And when we met, I figured out the unit mix. I figured out which one is debt-free, which one still got loans on it, and all sorts of information. So I am able to ring those owners, private owners who own 650 houses, units there, 350 there, and ask them recently, last week, how is it going? If they had any tenants ringing them, telling them that they can't pay, any delinquencies started or anything like that. So far, I see it around 1%. And that's also something that we talked to the property management company, and we are expecting delinquencies, but so far it's about 1%. So it's going to happen. It's just a matter of what. And the banks are wary of it. One of the things that you should do is to really prepare your T12 so far, the rent roll and your balance sheet, and ability to show how much reserves do you have. And once you got that, you can start a discussion with your lender. Perhaps you want to discuss locking the rate long term, on a lower interest rate. You really need to show some liquidity. Maybe you have some default reserve account, which we had to do when we did the latest transaction. We had 25% vacancy, and they wanted us to put a certain amount of money in a default reserve account, like a deposit that I'm not allowed to touch. Maybe you want to extend your interest only. So I think the banks, to answer your question, Cody, the banks don't really know right now how to deal with it off the cuff, because this thing is just evolving. It's just starting. But there are some steps and measures that you can take to protect yourself. And some of them, I will cover all of them in the session that we're going to do next week. But some of them is really to try and create liquidity. There is one thing that I would like to give to the listeners right now, is try and create as much as liquidity as you can. Whether you create a business line of credit or a home equity line of credit on any assets that you own, so you have some cash, you have some money as reserve to weather the storm. With regard to agency debt, you can expect to have forbearance agreements coming up from Freddie and Fannie, which basically means that you can hold back the payments and not pay a mortgage payment for, I think it's up to 12 months to defer those mortgage payments. And within the 12 months, and I touched on it before, you can't evict any of the tenants. They want you to keep those tenants in place. But that will be depending on your financial position, your cash positions, and really you need to show your financial statements and position that you'll be able to pay that. They're not just giving it away and you don't have to pay it back. You have to pay it back within 12 months. So the forbearance agreement, that's something that will happen, and something that will be, if you like, some mortgage payment relief for a set period of time. In
your conversations with other operators, are they worried about liquidity? themselves, or are you hearing rumors of other folks that are strapped?
It's too early to know. I mean, this thing is just picking up momentum now. So I haven't heard anything just yet, but I bet they are. Of course they are. You know, if you have, let's take a step to the syndications now. A lot of people who syndicated deals, some people took the strategy that we talked about. They bought an asset for a 4 cap, and their strategy was to take it to market from what they got. You know, maybe add $200 a month. That's gone. You can't do it now. You'll be lucky to keep your tenants. So, you know, that's a strategy that they can't. Maybe they're negatively geared. Negatively geared means that their mortgage payment are not covered by the rent. So if they're negatively geared, that's costing them $20,000 a month or $15,000 a month. So, you know, this is a problem. And that will start rolling, I think, May, June, moving forward. People will start, unfortunately, and I hope not wish it to anybody, including myself, to feel the pain. It's very, very important. That's why liquidity is so important, and cash is king.
That's a very good point. And so, you know, my question to you now is, what is your strategy moving forward over the next couple of months until we get a feel for how this is going to truly impact us? Go ahead.
I'm sorry. No, you go ahead.
No, I was just going to ask you, are you continue to be active in the markets that you're invested in? Are you going to sit back and kind of watch? What's your strategy?
No, I'm first of all, I'm current, and I've been doing it for the last 4 months. Like I said, I'm self-funding my deals. So I'm kind of using my own resources to take down opportunities right now. I am basically, and I've been doing that for the last 3 to 4 months. I'm only concentrating on my asset that I bought. It was a heavy lift. We now finally finished renovating all the vacant units. We had a couple of turns from people who we evict them basically, but luckily we didn't have to go to court. They just moved out because they realized that there's new sheriff in town who is going to be, wanting them to basically leave if they don't pay the rent. So they left. So we fixed up, and the asset, if we can fill up all those, we got 6 vacant units right now from about 20 that we turned, and we're going to fill them up. There is kind of a waiting list, hopefully. So once this is filled, my strategy will be, again, to have a tenant retention strategy, and we're going to get into the details of that and on the course that we're going to do next week. But one of the most important points is that I'm going to get this asset, if I can, stable. I'm not increasing rents anymore. My plan was to actually go to the existing tenants who were paying $445 to $450 and tell them that they need to go up to $595 or get a deal with them. Usually we do like the first 6 months or 3 months, the same rent, and then they can go up to market, because they were just sitting there. That's why the deal is so good. There's a lot of meat on the bone. So the strategy was to fix those vacant units and then go and deal with the current tenants. But now we're taking a step back. We're not going to increase those rents, which means that I might need to wait patiently until I'm going to refi the property out and pull my money out. So, but I want to do that. So perhaps, hopefully, if everything gets kind of stable with the tenant base is good and demographic, hopefully we'll be able to get some support, this $1,000 or $1,200 a month from the government to pay the rent. So if we can keep it stable with the income level that we are aspiring to be by the end of March, April, according to the original plan, then I will approach a local bank and I will approach a bank and try and refi the property out. So a lot of people, if you're listening to that, if you can refi your property into better terms, perhaps lower interest rate because interest rates have dropped, perhaps a longer amortization, if it will help you, it's something to consider doing it right now. Perhaps extending the interest-only period as well. This is a very important point if you can do, which is something that I'm certainly going to try and do if I don't refi in time before my first 12 months interest-only period expired. I'm really, really definitely going to try and do that. Did that answer your question?
Absolutely. No. And I think that's great. And I think, I hope that the listeners out there that are listening and who may be faced with some of the same challenges that you're describing, I hope that they take that advice and implement some of those same strategies. I think that's definitely the smarter play right now.
Yes. And I want to say that, again, going back to the syndication, because I know that you guys, have a lot of interest in syndication. Most of the syndication that I talk to, and I know, they actually stop distributing the income now. Yeah. So one of the keys that we're going to implement as well is try and retain as much as cash as you can in-house. Whether it's reducing some expenses, whether it's not distributing anymore, whether you are closing the swimming pool because people are not going to use it anyway now, whether you're going into summer now, I know, but because of the virus, you can't use it anyway, and you can cut on the cost of running it. Whether you are trimming in some other places to cut costs, like for example, if you close the office, you only need to have one person on call, so you can just pay less staff to work. So there are going to be challenges, but there are ways that you can try and really be more conservative. We're not going to do any major unit turns anymore. We're only going to address small maintenance requests, which are essential, like HVACs, gas, electric, and plumbing. That's it. All the small bits and pieces could wait.
Mm-hmm. That's great. That's great. So, well, listen, Hadar, man, this has been a fantastic conversation, and unfortunately, we're getting near the end of our time here, and but we definitely appreciate your extensive knowledge and all the great nuggets that you've dropped on us today, and we're looking forward to learning more from you at your events next week. So, but before we go, I have a couple more questions for you, and then we'll wrap up. So, what do you like to do for your continued education and learning to further your investing career?
Well, I always read books and listen to podcasts. Always, I think that keeping the education going is very important. We always grow. We always want. I do a lot of mindset stuff as well. So I'm big on personal growth, because a lot of the success comes from acquiring more knowledge, having coaches to help you to take your business to the next level. But if you don't have the right mindset, you can't execute on it. You can't really keep going when it's tough, because real estate could be a lonely business if you're doing it on your own and you're not surrounding yourself with like-minded people. There's a lot. It's not an overnight success. It's a marathon. It's not a sprint. So it really takes time to build wealth and to pick up momentum. And you really need this support. Even when you pick up momentum, sometimes there are roadblocks and road bumps or whatever, and you really need to have this support behind you to keep going. Because I'm telling you, doing it for 15, close to 20 years now, I'm really, I remember the days when it was frustrating, when you can't get a deal or you're not picking up momentum. And if I wasn't strong enough in my head, because I'm kind of self-motivated person, you can tell. But, if I wasn't strong enough in my head, I would never survive this. I gave up and thought that real estate is crap. But getting coaching, accountability, joining a good mastermind group with good support is the most important thing.
What's your favorite mindset resource?
Oh, books, definitely books. And I do a lot of meditation. So meditation is a practice that I picked up about 4 or 5 years ago. I was in a situation that in a real estate transaction that went wrong. Well, didn't go to plan, didn't go that wrong, but didn't go to plan. And long story short, I was under stress and I started getting into meditation, and it really helped me to get balance right. So mindset, for me, it's a combination of learning about that and reading the books, motivational and things about how to really take yourself to the next level. But physical exercise, meditation, putting things in proportion, and talking to other people, that's pretty much my rules, if you like, to keeping sane in this business.
Who's been your biggest inspiration that has helped you grow your business?
With Multifamily, I must say that Jake and Gino have been a big part of my inspiration and growth. Guys are, been with them now for close to 4 years, and learned a lot, and really appreciate these two guys. I think they're They're a great inspiration.
Same here.
What advice would you give to the listeners to help them grow their businesses?
So again, the number one advice in my view is the education, the coaching, and the support group that you need, because you don't know where you don't know, and you need to shorten your timelines to success by surrounding yourself with the right people. That's number one. Number two, I'm saying avoid the shiny objects syndrome. You have to avoid the shiny object syndrome. Focus on one niche, focus on one strategy, and stick to it. Stay focused on that and stick to it, because you want to become expert in it. They're saying the richest in the niches. That's kind of the idea of really being focused on one thing and avoiding the shiny objects syndrome. Don't start thinking about doing some Amazon marketing and other things which will take too much time of your time if you're starting to learn and educate yourself in real estate. Unless you're capable and your wife is helping you or something, but stay focused so you can really propel yourself, because there is always something else you can do. There is always more direct mail marketing you can do. There is always more networking you can do. There is always something that you can do to continue making it happen and continue pushing towards your goal. Very important. That's what we do in the mastermind. We sit on the people, we keep them accountable to make sure that they implement the plan, the quarterly action plan, the weekly plans that they have towards achieving their goal. Very important, because if you don't, you're just not going to get there. You have to keep pushing. And that's the thing I like about Jake and Gino so much. They're go-getters. They want to make something. They think about it one or two times, and then they go and they execute. That's it.
Make it happen.
Make it happen. And this is really, that's why I'm so connected to the community and to the Jake and Gino concept, because I'm this kind of guy, so it's really really nice. Another tip, focus on one market. Be open to invest out of area. If you are investing in a market which doesn't offer a good rent to price ratio, I really suggest that you consider learning and educating yourself how to invest out of area and go and make it happen, because it's doable. If I'm doing it from New Zealand, you can do it if you are in the States. So don't give me any excuses. With that, it goes point number two, four, whatever it is, very important, know your market. Once you've chosen the market, know your market. Network, relationship with local lenders. If you go and choose a market and you want to get to know the market, you really need to talking to everybody in that market, going to meetups, networking with lenders, with property managers, with fellow investors and lenders. Once you've chosen one or two lenders, go and open a bank account with them. Open a bank account, put $1,000 in the bank account, so you have the relationship going. So you're already a client. You're already an existing person. That saves my deal, my recent deal. I had lender who took me to lunch and meet and greet and everything in theory, and I've been talking to them for 2 or 3 years. At the end of the day, a couple of them who promised they're going to do the deal, they went to committee, and the committee were 12 people on the committee, and they didn't approve the loan because there was 25% vacancy, and because I'm in New Zealand, US citizen, but in New Zealand, and all that story. At the end of the day, the bank who came to the table was the bank that they already had a bank account with, had a credit card with, and they know me. I have a relationship with them. So the terms weren't ideal because it was a heavy value add deal, but I got the deal across the line. So very important to stabilize those relationships with the bank really early. And the last point I want to make for the listeners here, buy value add and yield. So that's what we talked on the strategy. You buy properties when you can have enough equity built up by repositioning the asset and increasing the income, so you can really have the ability to perhaps refi and roll the money out, and also have enough meat on the bone. So if property prices drop in a recession, you are not upside down in terms of the value.
All right, Hadar. Well, man, how can the listeners get connected with you and learn more about you?
Visit me on the mihmastermind.com website. And really, I'm really looking forward getting to know your listeners. And if anybody wants to learn more about the mastermind, feel free to hop on and book a 30 minutes free strategy call with us, with Marco and myself. And we're going to see if it's a fit. And if it's a fit, you can join one of our groups of 4 people and keep making it happen.
That's fantastic. By the way, for all the listeners out there, The real estate cycle, I just pulled it up on my screen, mfiholding.com, top right-hand corner. Click it, fill your information out. You'll get the book. Looks awesome. So thanks for publishing that.
Thank you.
Well, thank you again, Hadar, man. It's been great speaking with you, and we look forward to staying connected, okay?
Absolutely, guys. Thanks for having me, John and Cody. I appreciate it, and make it happen.
Yes, sir.
Thank you. It's an honor. Thank you.